So when it comes to investing, there's two major components that we've all heard before. It's risk and reward. If you're willing to take more risk, you have the potential of seeing more reward. Same thing applies for commercial real estate, but I think it's important to understand the four strategies, the four kind of major conventional strategies in commercial real estate, and how they reflect the type of investor you are, so you can best allocate your investment according to what your goals are. So the four main strategies are core, core plus, value add, and opportunistic. For a core strategy or a core investor, your main goal is consistent cash flow. Cash flow is what you want. You don't want risk. Volatility is like your worst nightmare. All you're concerned with is cash flow. So you're buying stabilized buildings, really good condition, prime location. And I think the good thing to remember is you're willing to have smaller returns. Typically it's single digit returns, 7 to 9%, because the last thing you want is risk. From a debt standpoint, usually it's somewhere from 0 to 50% leverage. And these are usually in like metro areas, New York, San Francisco, LA, just think prime time. For a core plus investor, cash flow still is very important for them, but they're willing to take a little bit more risk, not a lot. This might be something like the building is in good condition, but it might need renovations down the line. It's still in a good location, but maybe it's not on like the hottest street. You might be 3 blocks away, but still good condition, good location. From a return standpoint, you see a little bit more bump, somewhere between 10 and 14%. And then from a leverage standpoint, it's usually 50 to 65%. On projects like this, from an unleveraged standpoint, the returns are big enough to support adding leverage, but because you're having to keep it from a risk tolerance of core plus, you're limited to adding more debt. So typically you don't see anything greater than 65%. As you get into value add, you're buying projects that something's wrong with, and you're gonna go in with a business plan to fix the problem, which is gonna give you a higher return. So you still see projects where they do maybe have small cash flow, but you're more focused on increasing the return by what we call forcing appreciation. And that's really you doing work to add value to the property. So in the apartment, kind of using the apartments for an example, if you can increase vacancy, if there's a renovation that helps you increase rents, you're increasing your NOI, and the NOI, by increasing NOI, you're increasing the value of the property. From a return standpoint, this is typically 12 to 18%. Debt can vary, but usually it's somewhere between 65 and 85%. But the thing to remember, you're going in with a business plan, so your returns are gonna be based on how good you are at sticking to your strategy and business plan, because remember, there's something wrong and you're going in to fix it. Opportunistic is, this is a group that isn't concerned with cash flow right now because they see a path to a greater return down the road. This would be development projects, repurpose of assets, so taking one use and converting it into another, foreclosed buildings, vacant buildings. Because there's so much more risk and you need expertise to get through it, you do have the potential to seeing large returns. But again, like value add, it is based off how good the group is at sticking to their business plan. From a leverage standpoint, it's too broad to say because it is more kind of case sensitive or based on each project. But what you do see a lot of times is on a development deal, you'll come in with no leverage, you'll buy the property outright, and as you start moving closer down the road of your business plan, you start taking on leverage or increasing leverage. And really, I think the thing to remember is what type of investor you are and what you're looking for. If reward's not your thing and you just want consistent and you're okay with small returns, don't look for value add or opportunistic opportunities. If you want to take on some more risk because you want greater returns and you might not need cash flow right now, well, those might be the opportunity you're looking for. But remember, on value add and opportunistic, it really comes down to how good and the experience the sponsor has at working through their business plan, because the success of the project is going to rely on that. So keep all of those in mind. I think it's good to decide what type of investor you are, and then search the right deals according to what you're looking for.